Good afternoon, this is Todd Colvin coming to you from the floor of the CME Group. We are looking at rates and 10-year note yields still holding the range. We had that extension of the old 280 to 3% range. We actually extended that up to 310. We've continued to hold that range. I think right now the market is still kind of waiting. If you look at riskless assets, that's treasuries and gold and things that you would buy, sort of that flight to quality bid, they aren't overreacting. You look at equities, risk assets, they're booming right now, with the idea that things are all going to be great and the data keeps coming in friendly and we're getting good news out of the trade side, but there doesn't really seem to be that reaction on the other side of the coin. And I think right now we're seeing in treasuries is just that. We're building, we're consolidating. Yes, we're nearing the top end of that range, but we have yet to push through it, and we have yet to see really a significant knee-jerk reaction to anything that's going on. So I think right now treasuries, while nearing the top of the range, remain sort of in that wait-and-see mode. And if you look at market volatility, Treasury volatility tends to trend lower when we stay within the range, and that would be what's happening now, except for the fact that we're not going lower. We're just holding steady, which again tells me that the market is waiting for something to happen, or it's at least not. It's positioned for one that what if equities reverse? What if there's some kind of mess up with the trade deals going through with Mexico or Canada? What if something happens with China? What if something happens in the credit markets? What if something happens in Italy? There's a lot of what ifs out there, and I think the fact that the Treasury volatility, which is known for declining, hasn't been so over the last several sessions, really since FOMC, suggests that there may be something in the cards. It's not pricing any fear in yet, but we are seeing the market sort of wait and see. And again, it's the riskless assets which are doing that, along with gold. You're seeing treasuries do it now, and let's look at positioning. Well, very similar to gold, the speculators, what at this point we'll call the leverage funds or the hedge fund community, they remain near all-time short. So they are continuing to pile in or stay in those short positions with the idea that yields will go higher, with the idea that the back end of the curve may be mispriced here, and with the idea that that policy is going to work and we're going to see higher inflation and more growth down the road. And I think that that's probably the smart trade. However, when everybody's on the same side of the boat, it doesn't usually work out well for everyone. So I think right now that the market, we're continuing to see the yield curve remain relatively flat based on the fact that we are seeing rates go higher. But it's going to take some time, and I think that if we do see a move north of that 310, maybe get 10-year yields north of closer to 320, somewhere where 30 years are trading right now or close to it, that would be something. That would be an it moment. Otherwise, I think we're going to go back to trading the old range. If we ever go south of 3% again, at least in this next little move, that could mean that we're stuck in that range probably till the end of the year. So right now, we hold the upper end of that range. Can we push through in Treasury yields? It is yet to be seen. This is Todd Colvin coming to you from the floor of the CME Group.